Welcome to It's the Economy. Tariff threats from President Trump are hitting the market with unfailing regularity. In practically every speech, the president makes it a point to threaten India with reciprocal tariffs. Now, how much higher will tariffs go? Which sectors are vulnerable from a stock market point of view? And what's the impact on India and Asia as a whole? Impact on currencies? I have with me someone who's an expert on all these issues and has written an excellent report, Andrew Tilton, the chief Asia Pacific Economist at Goldman Sachs. Andrew Tilton is with us in the studio, and thank you very much for that, Andrew.
Thank you for having me.
Okay, well, let me start with the serious stuff, the impact of reciprocal tariffs. It's very confusing. Will it be product by product? Will it be, one for the whole, world, that everyone gets a steel tariff, everyone gets... How do we think about this tariff?
Well, we expect to see reciprocal tariffs imposed probably in April. President Trump has asked for a number of reports and analysis and expects to make a decision in April. As you noted, it could be making the overall level of tariffs equivalent or product by product. Now, we've calculated that in the case of India, the former would add 6-7% to tariffs, U.S. tariffs on India, whereas the latter, that is product by product tariffs, could ultimately mean an increase of a little over 10%.
Okay. So in that case, what should India be worried about in terms of a GDP impact in either case?
We expect an impact of between 10 and 30 basis points, so not a huge impact. India's exports directly to the U.S. are about 2% of Indian GDP. So it's a manageable hit. India is a large, relatively closed economy. So we think this will not knock India off a reasonably strong growth trajectory.
Okay. No, that is a consolation. But, let's look at it practically. Is it, after all, we have an Elon Musk and a Doggy, which wants U.S. to reduce the size of government. Will it be practically possible for a customs department to look at product by product, country by country, and even administer this level of tariffs? So practically, what should we expect?
On the analytical side, it's pretty complicated. If we're going to match product by product tariffs, and it's not just India, of course, we're talking about doing this for the whole world, that could delay the implementation, perhaps to mid-year or even later in 2025. In terms of actually administering the tariffs, I mean, we do have, as you noted, a customs service, so the machinery is there, but the implementation of all the various tariff codes is going to, and figuring that out for each country is going to take some time. I just add, this is, I think, not likely to be an issue for India, but the so-called de minimis tariff, where you can send in packages under $800 directly to U.S. households without any tariff, that's going to take some new machinery because our postal service doesn't normally charge tariffs, but that's likely only to affect China.
Oh, okay. That's a separate problem we didn't think about. But even coming to the tariff, assuming it's product by product, or even if assuming it's on a country, but it is a little punishingly high, won't people dodge it pretty easily? I mean, having a trading company in Dubai or some other country which is not similarly punished and routing it, these things will... I'm just wondering if the tariff threat is as big. The market is really scared.
Well, we've seen already from the first trade war in 2018 to 19 that there was a meaningful trade rerouted from China to third countries, Vietnam being an obvious example, where we see an increase in Chinese exports to Vietnam, increase in Vietnamese exports to the U.S., and, of course, potentially saving tariffs. Now, I think the impact of that, first of all, is that there's a risk Vietnam faces tariffs down the road from the U.S. But as you noted, it is possible we could see some rerouting as part of this global trade shift and these tariffs imposed by President Trump. That will likely mean there are potentially future actions or efforts to trace back products to their origin. So that's going to increase the complexity of this over time.
Okay, now some more micro questions. Which sectors in India would you worry about?
Well, in terms of sectors that might see lower tariffs in order to stave off the increases on the U.S. side.
Yes.
I believe we've already seen some cuts in motorcycles,
Big
electronics.
cuts in motorcycles.
So those would be a couple of areas that would be affected relatively sooner. I know there's been some discussion of autos potentially. So those would be a few that I think are in focus, not just for India, but more generally from the U.S. perspective.
These are industries or companies which will face foreign competition, right?
Yes.
And therefore, makers of electric cars or makers of bikes better watch. There could be competition, though, of course, their products are pretty expensive even without tariffs. What about Indian exporters getting hampered because they have been priced out? Or do you think they're priced elastic?
Well, I think that it really depends on the sector. I mean, we're seeing, in some places, President Trump, for example, talking about tariffs on semiconductors. I mean, less of an issue for India, but I think not likely to have a big impact on U.S. demand. Whereas goods that, as you said, are more elastic, if we're talking about apparel, something like that, differential tariffs on one country could cause a shift in demand to another. So I think some of the Indian exports to U.S. would be in those categories, and we could see a modest shift. But of course, we're seeing U.S. tariffs potentially on the whole world as a result of this reciprocal tariff initiative.
So if it impacts us, it impacts Bangladesh as well. Probably it will impact other apparel competitors. Would you therefore say that, when you look at India and look at our GDP, and recently you'll have upped the forecast, you worry more about domestic India, right? The consumption story in India or the capex story in India is more important for us to track than tariffs, would you say, when you are arriving at the GDP?
Yes, the external environment has been better. This is obviously a difficult time, both from the standpoint of competition from China as well as the potential tariffs from the U.S. But we really focus more on the domestic economy when it comes to our India growth forecasts. We have a reasonably optimistic view looking out a few years. We think the economy can grow 6.5% or better. But recently, the combination of fiscal tightness and so far only one rate cut from the RBI means that the domestic economy has been under modestly tighter policy in the past year.
Yeah, but you just released a report upping the forecast for, I think, the last quarter that went by and the current quarter.
We made a slight tweak based on the fact that it looked like government spending had accelerated in the late 2024. And that it should boost Q4 growth. We took a tiny bit out of Q1 as a result. So I wouldn't call this a major shift. It's more a timing question.
Every little bit helps. That 5.4% GDP growth number for July, August, September has rattled us. So even if you're going to, up it to 6.3 or 6.4, that your number is, it's welcome. Let me look at the currency aspect, which has rattled foreign investors a lot. Do you think we are done with it? We had the Reserve Bank bulletin indicate that the overvaluation is substantially lower. In November, it was 108, indicating 8% overvaluation. The last bulletin said it's only a 4% overvaluation, 104. So you think the rupee is done with its serious depreciation?
Yes, largely. We have a forecast that's essentially flat over the next 6 months. We did see clearly, as you noted, a correction. And in light of efforts to boost manufacturing in India, the Make in India initiative, it's probably better to be more aligned with those currency valuation metrics rather than being overvalued. I mean, again, according to that metric, the challenge of exporting in the current environment with both, again, China competition and potential tariffs means that, overvaluation would be a third challenge India doesn't need.
No, absolutely. I mean, I don't think the Reserve Bank would normally want it. It was perhaps just a brief period when, for whatever reason, the rupee got overvalued. And maybe perhaps Trump's election and his subsequent announcements were unexpected. But what's the range? Is it like 87.5 or 88? There are people even talking 90. So what's your expected range? Out
6 months, we have 87, and then slightly higher, 87.5 in a year. So it's really quite a small shift from where we are currently.
87.5, we have been there, done that. And now strengthened to, I think, 86.8 levels. What's your sense about Reserve Bank rate cuts? And now, do you think it's tough, or because the currency challenge is over, they now have more space for rate cuts?
Well, we think they were prudent to wait in light of uncertainties around both the trade environment as well as domestic inflation. But we do expect at least one more cut in light of the recent inflation performance and the fact that growth is slightly below, I think, policymakers' aspirations as well as our estimates of trend growth.
Oh, yes, aspirations are to touch 7, but, that happened only for 3 years after COVID. What's your sense about the U.S. Rate cuts? Do you think we are done with it, or can we expect the FOMC minutes did sound hawkish? So do we have a cut down?
We have 2 cuts in our forecast this year, one in mid-year, one in December. That said, I would say our conviction on this is not especially high. It's clear that the Fed is going to be on hold at least for the next couple of months. They don't know, neither do we, what President Trump exactly is going to implement over the next few months, and that will clearly matter for the U.S. outlook and the Fed. We've also had, I'd say, some mixed data recently, a softer retail sales report, which probably was due to weather issues in January, but nonetheless has raised a few questions. So the Fed will likely want a little bit clearer read on both the domestic economy and on the new administration's policy before making any further moves.
What's your sense? I mean, this is more a market man's question, but then you advise your markets team. This U.S. exceptionalism, money being pulled out of every emerging market and rushing to the U.S., does it taper off? I mean, we did see a fall yesterday, but does U.S. Continue to be a magnet?
I think there are a couple underlying drivers of this U.S. exceptionalism. One is clearly tech, AI, the excitement about the Mag 7, as it were, the inflows of equity investment from the rest of the world to be a part of that. That will eventually fade. I'm not going to tell you exactly when it happens. I wish I knew, but we think the investment boom in chips, in AI investment continues into 2026, so we don't see any immediate end for that inflow. And then there's the dollar, which is benefiting both from that trend, but also from tariffs. We would typically expect a country that imposes tariffs on others to have its currency appreciate. And we've seen that when markets have gotten more worried about U.S. tariffs, the dollar has tended to appreciate. Right now, I think there's been a little bit of relief that we haven't actually had more tariffs imposed.
Yes.
But, as we've been discussing earlier, I think it's likely we see tariffs imposed sometime in Q2, and so we would expect another leg higher in the dollar. So to answer your question, we think we probably still have a little bit more U.S. exceptionalism, at least when it comes to the dollar, over the next few months.
For a better part of 2025, we have to tackle U.S. exceptionalism. Any range for the dollar index?
Well, the amazing thing is we're at a 40-year high, or very close to it. We recently hit a 40-year high in the dollar on a broad trade-weighted basis. So looking out a few years, we would expect the dollar to depreciate, but we think we have to get over the hump of tariffs first. The last round of, if you want to call it, global tariffs probably need to be clearer in the mind of the market before we can be comfortable that we've peaked in the dollar.
Okay, so it's possible that smart money comes back to emerging markets like India before 25 runs out.
We could see that, yes. I think we could see a better environment for EM. Typically, that's been the case, when the dollar has peaked and when we've been in the Fed easing cycle. Tariffs are probably the most important factor impeding that right now.
Okay, well, let's hope so. On that optimistic note, Andrew Tilton, thank you very much for joining us in our studio.
Thank you.
So there you are. There is the immediate tariff hump, but hopefully by the end of the year at least, U.S. exceptionalism would have peaked off. That's it on this edition of It's the Economy. Thanks for watching. After a break, Chartbusters.